Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, April 12th, 2016. In this video, I wanted to really expand on the video that I did yesterday. I put out a video on the shipping stocks, and in that video, what I covered was a watch list that I've had for many years in trading the shipping stocks long and short. And I had mentioned in that video, I was a couple things. I was very clear on the risk involved in those stocks in that watch list. Is many of those stocks were either, they were all small, well, below small cap. They were either micro caps or actually nano cap stocks. Nano cap is a term used for the smallest of the small stocks, and micro caps are very small, right up there above that, typically between, smaller than what you'd find in the Russell 2000 small cap index. So high risk, high volatility because of that small float, low market cap. Now what I've done, because I am liking, and the more I looked into this yesterday, after that video, I'm liking a lot of the developments that I'm seeing on the charts, and I'll go over that. And I've also taken a dug down into the SEA. I touched on this lightly yesterday. SEA is the Guggenheim Shipping ETF. So what I did is I added to my watch list some of the more stable, larger cap shipping stocks, and I'll go over that today because I do think I see a lot of things I like, some developments in the sector, and I'm still partial to sniffing out the most attractive names because I'm not really bullish on all the names in there. With that being said, I'll start here with the chart of SEA for those of you who are risk adverse, maybe want some exposure to the shipping sector or something different, and that's certainly a viable option. And then I'll dig into the charts of just some of my favorites. I won't spend time on the ones that I covered yesterday. Those are the explosive names. If the shipping sector starts to move, as it did just a few weeks ago when I highlighted that, the smaller, typically, the smaller the company size, the more explosive the move will be if and when, that particular stock catches a bid. Now, here's the thing. The reason I don't just put up two or three of my favorite is because I do like, as I said, I like to take a shotgun approach. You never know for sure which ones will pop and which ones will pop the most. And that way, if you sprinkle a little bit of cash, if you decide, hey, it's all relative to your portfolio size. I'm just picking a round number here. If you decide you want to put $10,000 in this sector, or $1,000, doesn't matter, whatever your portfolio size is. Make sure it's a fraction of your portfolio size. Please don't put half your money or more into these stocks. But if you decide to put 10,000 in there, then what you do is you pick maybe some of the larger cap ones. You can pick a few, put up $1,000 in there, and then those micro caps if you want to have some speculative plays in there. $500, something like that. Adjust for that additional risk and loss potential. In other words, what I call beta adjusting. So let's dig into the charts. We'll start with C for those of you that are interested. And I have to say, I'm not screamingly bullish on this chart by any means. It's rare that I do two follow-up videos, one right after another. Usually, if I'm interested in a sector, if I'm trading the miners actively, I'll do a video maybe once a week. But again, there's some additional things I wanted to add here. So, looking at this chart, we do have, as I mentioned yesterday, we had some divergence at the low, and that did play out for this bounce that we've had already. So, whether that was enough or not, I do like to see, as most these divergent lows to help confirm a trend change, because you can see, as you see here, the shippers have been in a vicious bear market, may continue to be. Only time will tell if this isn't just a bear market rally. But as you can see from the point I grabbed up there just almost 2 years ago, this sector, or at least this particular ETF, has fallen by almost 60%. And, recently off the lows, like everything else, I have to say that, when the broad market rallies, most sectors will rally with it. So we've had about a 27 or so, maybe 30% pop since the February double bottom lows here. And this is a downtrend line that I'm watching. If and when this is taken out, that will really start to firm up the longer term bullish scenario, show that this double bottom was in fact likely a bottom in the bear market in the shipping stocks, and there's some work to be done. As you can see, I have this banded sort of right here, this range banded by these red lines. In other words, this red line is a more significant resistance level than these two right here, and this is a pretty significant support level. It was breached a little bit there, so you could actually, you know what, I'd be remiss not to put a line here, because that catches that reaction high there, and it catches that recent reaction low. So this would sort of be, we'll call it a line in the sand if you want, stop level. If you decide to go long, I'll color that orange. I'm starting to look like a rainbow here with all these colors. But again, I just wanted to point out the significance of these levels. So there's some work to be done, and where I'm going with this is we may continue to base here in a sideways range for a few weeks, a couple months even, and then ultimately, if the bullish case is indeed going to play out, then ultimately break above this downtrend line and of course this reaction high. So I don't think I need to draw that out. I think you guys can visualize that. I circled here, you know, potentially bullish development. The MACD is above the zero line. That tends to define uptrends from this period here to here, and it tends to do a good job of defining downtrends from here to here. At least, you know, and you can see here at this point, I like to use the 9 EMA. When using this as a trend indicator, I'm more focused on the 9 EMA. We'll color it white so you can definitely see that a little bit better. And you can see how the 9 EMA came up and went over just a hair, but for the most part it back tested the zero line and rolled back over, confirming that that trend was down. And now we've punched solidly up above it and we're curling back up. You can see a potential bullish cross here. So that when the blue line crosses over the signal line, you know, the blue line's your MACD line, then white line's a 9 EMA. That's a bullish crossover. The fact that it's also curling up right on that back test of the zero line is also bullish. So net, I like that. That's some nice price action so far. And again, I don't expect fireworks until we clear that range and clear up there. But what I do like about this chart, if you look at the volume at price histogram bars, that's these green and red horizontal bars, there's a big thin zone right here between this key level, and I'll color code that. Don't hold me to it. I haven't zeroed this into the penny, but that's around 1240. And my expectation, if and when that level goes, as well as the trend line, it should be a relatively swift, you know, relatively swift and straight move up to the 1425 area, because that's a thin zone. Thin zones work a lot like gaps, where there weren't a lot of trades in there. You know, we did have some trades. It wasn't a gap, but very similar in nature. This is the weekly chart. Here's that downtrend line again. We need to take that out. You know, as I say, I'm a big fan of divergence. They're not the be-all, end-all in trading, so you don't always have to have them. But as you can see here, this was a bear market back in 2012 that ended in early 2012, and that was marked by a nice clear divergent low in the shipping stocks that led to this strong rally, called a bull market, a mini bull market, if you will, at least a strong rally. And, you know, that was just basically, looks like a big steep rising wedge. Then you had prices moving up in this nice, well-defined uptrend, wedging at the top, like is so often the case, with divergence confirming that negative divergence, and then boom, that kicked off the great bear market that the shipping stocks have been or may currently still be in. That was back in, well, the top was back there in June of 14. You can see beautiful technical analysis, well-defined trend line, breakdown, back test, whoosh, roll over. And this is what I call the moment of realization, when the bulls realize, okay, this was the real deal, and the bears realize it too. They see a successful back test after a breakdown, and then boom, that's where the bottom falls out. So nice wedge type pattern. So you can see everything's there on the chart. And I will point out that I don't see divergence. I do see a bullish crossover in the PPO. I like to use the PPO on this time frame. So that is a plus right there. You can see the bullish crossover. Now, one thing I can see forming here is maybe these shippers take another leg down. There goes a trend alert on Smith & Wesson. Let's just take a look at that real quick. Ooh, little room to go. There's a potential shorting up for you guys, but I'll check back on that. There's a weekly chart. Let's get back to C. All right, pardon me, I just wanted to check that price alert. Okay, so here's SEA weekly chart, and I could see the possibility, just viewing this chart, of another thrust down. possibly even a new low. And that has the potential to put in bullish or positive divergence here on the MACD. If you can't visualize that, I'll draw it out here. Let's see. So something along these lines, a marginal new low, ultimately a breakout of that trend line. And if that happens, the PPO could put in a higher low. In other words, bullish divergence like this, bullish divergence there, and as well on the RSI, boom, whoops, boom, boom, like that. And I'd almost put it 50-50 odds. However, the charts right now, there's just too much that I'm seeing in these shipping stocks and the individual names to ignore, even if it's just for a trade, even if this isn't a position for the next bull market. As most of you know, I have my concerns on the economy and the broad market, and it would be very hard to see the shipping stocks enter a roaring new bull market with the broad markets selling off, because that will most likely confirm that the economy is turning down, or the expectations are it will. But then again, keep in mind valuations. The broad market's been roaring for years, and so the economy's been, although sluggish, it's been growing by all accounts, and yet the shipping stocks have dropped 62%. So sometimes it is possible that, these stocks are just, bottom line, they're washed out. And that was just one of the shipping stocks, and I might as well roll into the charts here while I'm at it. Okay, what I've done is I told you, here's my shipping stock watch list, and I've added some names. So now you can see I've sorted these by market cap, excuse me, with KEX at the top, a $3.2 billion company. So, these companies are in the billions, and you can see here, 500 million. And I'll stop right here. A lot of what I covered yesterday was down here on the lower end, these couple hundred million and below. So this is really for more of you that might be interested in the sector, but just refuse to trade, these micro cap and nano cap companies because it just doesn't fit your risk profile. So this is KEX. I probably could have added a little more to this chart here. You can see here. We'll see this on the daily chart, but I'll go ahead and annotate this while we're here. So what am I looking at? What stands out to me? I see a nice divergent low on the weekly time frame. There it is on the RSI, and we also have it, if I draw it here, about an equal low. Yeah, right about an equal low on the PPO. So that against prices making a lower low in a breakout. You've got this 40-week EMA to contend with. But this looks to me like it's flagging right now, KEX. It broke out above this downtrend line. It looks to be bull flagging, and it would not surprise me in the least to see this stock. I'll try to give you a flagpole measurement. We can do this on the daily chart too. And there's a flagpole. So breakout would take us, that's where the flag projects, but this would be my first stop. This is a pretty well-defined resistance level. I'll show it to you here, 70.50. And that, the stock's at 59, so that's a decent move. That's almost a 20% move. And let's take a look at the daily chart. Here it is. Stand corrected. This has actually been, we already caught this one. KEX recently hit. This was my first and sole target, and this was an official trade idea. So we already booked some nice gains on this. However, it might be time to recycle back in. At the time I listed that trade, I had this potential second target. So here's that bull flag we looked at on the weekly chart. And again, same story. You just take the point, the flagpole, measure it up to the top of the flag, add that to the lowest point if and when it breaks out, and look at that. Look how nice that. See, this is a line that I've had here for a while, and that, coincidentally or not, that's about where that flag measures, and that would take us, if the flag had perfect symmetry, that would take us out to, looks like June 9th if you look in the upper left hand corner. So that gives you not only the expected price move, but I find that these flag patterns often do play out with nice symmetry. So again, just by taking this line and duplicating it or putting it here, gives you not just the measured move in target, but also the projected move in price, or in time, I should say. So for you options players, I'm not condoning the use of options, nor especially on the shippers, but hey, to each their own. So there's KEX, potential second target zone. There's a flag. So this one might be added back as an official trade idea. Okay, let's move on. SSW, Not the best defined downtrend line. There's a second reaction. We had a third there. You can see a pullback. So that validated that trend line. This was a whipsaw signal, aka false breakout, bull trap, whatever you want to call it. But look how prices have really powered back up. Nice move today. Like I said, I'm seeing some momentum come into the sector, and I'm also seeing some technicals that confirm it. See the MACD above the 0 line, RSI punching back above the 50 level. You know, that 50 level tends to define uptrends and downtrends, not always perfectly, but roughly. Let's see if there's anything here to notice on the weekly chart. I mean, clean chart. Look at that big, gigantic, bullish rising wedge on the weekly chart. Super well defined, or very well defined trend line, negative divergence. And here's that PPO crossing up above. Look at it trying to make this. It has made a bullish cross by a little bit. Nothing confirmed yet. But as you can see here, looks like we're powering up here. This is almost a descending, broadening wedge. Call it whatever you want to. The most important thing is you have a pretty well-defined downtrend line, and prices seem to really want to be hanging in there. We didn't have a violent rejection off the top of that level, so this one may pop as well. And again, you can take SEA if you want to hedge your bets or diversify, or you can pick your favorites out of this sector, which is my approach. And again, I wouldn't be doing this in video format if I had just 2 or 3 standouts, but again, I just think it's a better play to spread your money around and take that shotgun approach. You'll have some winners and losers, but ultimately I believe that if you went with the stocks here, assuming the sector plays out, that you'll outperform the ETF many times over. MATX. This is interesting. I had this trend line here from before. I had this wedge type, broadening wedge type pattern, and you can see right here at this point where that little dot is, I notice how well it came in, and this is how technical analysis works. I hit the extension button here. I'll turn that off if you don't work with TC2000. You can see that's the pattern I had, and boom, look how well that line came in. And now, more importantly, that you might say, oh, that's random coincidence. Maybe, maybe not. What isn't is this line here. This is a very well defined at 3550 support level. So although this isn't my ideal type of chart, some of you might say, oh wow, that looks like a head and shoulders pattern now. There's just not any symmetry to this pattern. Head and shoulder patterns have to have at least a modicum of symmetry, and this doesn't. We have this big, bulgy, rolling over slow left shoulder, little tiny right shoulder. Maybe, maybe not. It's not confirmed by volume patterns neither, which is important. But here's the thing. With trading, it's all about risk reward. So there's a well-defined support level, which has acted as resistance many occasions when tested from below. Once that resistance level is taken out, former resistance becomes support. As you can see, in the support held, it held again, and so far it's held for the last few days. So this is trading. You buy it here just above the 35.50 level. Even 36.17, that's fine. You can buy it a point, even 2 points above that level with a stop below. So your downside is minimal. You can quantify your downside. You might want, whether you do a daily close, maybe below 35, I think is reasonable. That might be a hair tight. I'd say a daily close below 35, maybe subtract another 15, 20 cents. And it all also depends on your target. Everybody's different. A lot of times I shoot for the moon and stars on these trades, and sometimes I get it, sometimes I don't. A lot of times I'll have the earlier targets, I'll just start peeling out, booking profits in, raise stops. There's 101 ways to trade the setups here. And depending on market conditions, my plan adapts. If I have multiple targets, say 3 or 4 targets, if we're in a choppy sideways, go nowhere market, last couple weeks this market's gone nowhere, I might opt for those earlier targets, the hit and run strategy. But when the market starts trending, let's say the shipping sector gains traction, and especially if the broad markets go on to break out to new highs, and then that will confirm my these trades, and I will probably extend or hold out for the longer term targets. So here's some levels. I'm doing this. You can see these levels here. See all these highs back here, see this reaction higher here, and this reaction high. So that would be a potential target, 43.50, and this is another target here, 40.58-ish. So you go long, and again, calculate your risk reward using a 3-to-1 or better RR, risk to return ratio. That's what I like to do, and that might allow you for a little bit lower stop. If that 35.50 level goes, we have very good support also down here at 33, right around 33. So we'll make that an even number. It should line up. You can see all the reactions here, and then the big gap. Gaps. The top of a gap is very good support when tested from above. So this sort of plays into maybe that alternative scenario where the shippers might need another leg down. So if this doesn't play out, you want to stop out, cut your losses. Do you want to give it that much rope? You can. That's only 33. I thought I had that right on the $33 mark. Looking at the upside potential might work out. However, if you want to put a tight stop there, and then you can always re-enter, do the same thing back at this point. If it gets there, I'll tell you, you won't want to buy. The charts will look ugly. The stock market will probably be falling, but it's objective. If, and again, if and only if, this sector aligns. In other words, a lot of these other shippers are falling to support at the same time. That SEA, Shipping Index ETF, confirms. That's when you would want to go ahead and step in at 33. Otherwise, if things get ugly in the market and in the shippers, then that gap will be entered from above and will more than likely be backfilled. And then this would be a screaming buy here, again, if confirmed, down at all the way, that's the bottom of the gap, 29.50-ish. All right, too much time spent on that one. Let's move on. SFL, some work to do. Not my favorite chart. Did have a divergent low. You can see strong divergence, really. It's not marked. If you guys don't see that, let's draw it out here from this low to this low. But we had a hell of a pop since then. So that divergence has, in my opinion, played out. Doesn't mean the stock can't go any higher. It just means that the quick move off that divergent low, or the bulk of those gains have been realized already. But again, if the sector is bottomed at that point, you can see long-term support right here, and we hammered just above it. There's a downtrend line that it has to contend with. I won't spend too much time on that one. It's not my favorite, but it has potential. This is a current long trade idea on the site. This is a growth and income trade. This guy's yielding, it was higher, I think, when we put it on, but it's still yielding 12.25%. So we're getting paid to wait in this one. It's done well. That trade's up pretty nicely, and I have. Let's get back to the daily chart here. This downtrend line is the first target. I showed it on the weekly chart. I just made an update in the trading room on this. And I may very well extend the targets. I have this potential second target here, and then this downtrend line. So this will happen in conjunction. If this downtrend line is hit, and if this sector, the shipping sector, starts to firm up, we punch up through here. You can see this potential T2 is more of a resistance zone, and then it gets very thin after that. So my expectation is if this trend line's taken out, and these recent reaction highs, this stock is going to more than likely rip right on up again in what I call relatively short order. That means not in one day. Could happen, but I doubt it in this one. But that's a pretty nice move, and that would be, from where the stock's trading now, we've already done well on both the capital appreciation, the growth part of the growth and income trade, as well as that dividend. But that's another 50% higher to try to put this in perspective. So that's what these growth and income trades are all about, the growth part as well as the income. You're getting paid to wait even if things stall out. Just a fundamental thing. I made the case. I like this one. There's the shipping index and the stocks I'm covering, they're not all, each of these companies, they don't all own boats. They're not all shippers. Sometimes they have the shipping port operators, the crane operators, that put lift the cargo things on the truck. There's all different areas. So some of these stocks might not be actual shippers, and some that are, like Nat. What I liked about Nat is, from a fundamental point of view, they get paid to move and store oil. And everyone's thinking, sometimes it's a case of the baby gets thrown out with the bathwater. Oil prices have been moving down. However, that doesn't affect Nat's bottom line because they're not paid on the cost of the oil they're carrying. They're paid to carry and store. With this glut of oil that we've had, oil sloshing around the global economy everywhere. As you guys know, if you know about the fundamentals on oil, the hard part is where to store it. That's why prices get so depressed when there's a glut. It has a shelf life, and you have to put it somewhere. It's not paper like the stock market. When you look at a stock shares, that's just intangible. Those are intangible values. Oil is a tangible, a fungible thing, so it has to be stored somewhere. And a company like Nat benefits from that because they can store that oil even if they have to park. If they have a idle tanker, and just park it in port and store God knows how many thousands or whatever millions of gallons. I don't know how many gallons these things hold, but it's a lot. So they're paid for that. Anyways, let's move on. So there's Nat. And again, that's an active trade, so I'll keep updates on that one. And I may add a few others here. Sting, or Scorpio, I always call it Sting. Scorpio Tankers, I think I touched on this one yesterday, so I won't spend too much time. There's support right there, key support around 540, top of that resistance range, recent trading range. It's not so well defined at the top end, but this is sort of how I'd box it. So pop above that 645 level, it gets very thin looking at the histogram over here, and that would project this stock all the way up to the 750 area. So, if you're bullish enough, a lot of times, as you guys know, sometimes I'll do the traditional thing and wait for a breakout, and sometimes if I'm pretty bullish or pretty confident that stock, the next break is up and out of this trading range, I'll take a position within, maybe a starter or a half position, add when it goes up. But if you took one here, that's about 25.5% upside, and you're paid to wait. This one's yielding almost 9%. So again, this is where I'm looking to try to add as many growth and income trade ideas, because although my bearish market calls may not play out, I'm also nearly as confident that if the market goes to new highs, it's not going to run up another 20-30% a year for the next few years. That to me is just highly unlikely. Anything's possible. So, talked about maybe the fact we might be in a sideways range-bound market here for the next year or so, best case scenario. And if so, this is what you want to put your money in. Get paid to wait, even if you're wrong on the breakout or how long it might take. This thing takes a year to get out of there. Hey, you're getting almost 9% on it, as long as you don't lose on your original investment, which is always a possibility. So that's why you use stops. GMLP, looks like LNG, looks like natural gas. They must imagine they transport liquid natural gas, and some levels there. But you can see I put that little triangle pattern, which it just broke out of. This is definitely a level here to watch. That is 1640, maybe a little higher. You see these reaction highs right there. You see that reaction high test from above, reaction lows. And so if it takes that out, then you have this downtrend line to contend with. And from there, it should be pretty smooth sailing if and when that gets taken out. Probably take you all the way up to here. You can look at the volume price histogram, pretty thin all the way up to this level here. And that's at 24.25. Gas log, obviously something to do with gas, natural gas. Nice little chart, little wedge pattern, bullish divergence here, divergent low in this pattern, a breakout, strong move up to hit this downtrend line that started forming here. That's now been confirmed with that third reaction. Took a little breather to work off those overbought conditions. As you can see down here, it was quite overbought when it got there. As I mentioned, very rarely do you ever see a stock make such a tremendous run and then punch on right through a key resistance level like it wasn't there. If it would have broke out, odds are it would have come back in, and either that would have proved to be a false breakout or it would have backtested that line at a lower level. However, now we've worked off those overbought levels. RSI went back down below 50. So this one may have the umph it needs to go ahead and take out that level. And if it doesn't, I can tell you there's a pretty decent support right there around those recent reaction lows, around 890. Goes back. You can see here all the reactions. So there's the range bound. And actually, let's draw this out. Here's what I see when I look at that. I see a descending triangle pattern. You look at this right here, this line, and this line. So there's your pattern. This thing will probably coil in there, and the next definitive up or downside break is likely to determine where this guy's going. I shouldn't have drawn that arrow so high, but you get the point. So there's your pattern to watch, descending triangle pattern. Those things can break either way. All right, CMRE, nice looking chart. This one's trying to make the break right here. It's had a nice consolidation to work off the overbought conditions. So it, it has the fuel it needs if it wants to go ahead and make this breakout now or very soon here. Nice double bottom low like some of those other shippers. Double W pattern right here. You can see that. Let's draw that out for you. Oops, clear that. Well, you can probably see that, but I'll come this far. Let's just finish that for you. There's your W pattern. Boom, boom, boom. So what not to like about these? That's what I'm saying. There's, I don't see the divergence on each and every one of them, but here's a sector that's been beat down in a vicious bear market. I'm going over the stocks right now, the larger cap names. Teekay, this one looks real nice here. Here's a nice ascending triangle pattern, if you will. You have this uptrend line here. This is pinching between that 1042. You can just make it out there, the 1042-ish resistance level in this line. So here's one where I'd feel comfortable to go ahead and position now long, even though we haven't broken out yet, because it's pinching towards the apex of this triangle pattern, this ascending triangle pattern. And so your downside is easily quantified on a break, solid break or close below this this uptrend line. Now you might want to, being so close to the resistance level, might want to hold off. Maybe on the next pullback to this downtrend line, you go long there with a stop below. But this thing will have to break out one way or the other by the apex of that triangle. Looks like on Friday, March 13th, or May 13th. Noted here, the bullish crossover on the MACD. So looks good. And what I really like about this, I love trading gaps. This is a massive gap. Nothing there. We had this little spike here on the day of the gap down, but I wouldn't even be concerned with that candlestick. This is the line, as I said, 1026. Call it 1030 to be safe. Punch up into there, and you are likely to see TK fill that gap in very short order. All right, so that's TK, and there's the level. If it I would, on this one, I would almost guarantee a reaction at the top of that gap, meaning pullback, initial pullback, maybe some consolidation, and maybe it pulls all the way back and backfills the gap. But if it does get above there, there's another target for you. Anything on the weekly chart? Nope, just a stock that's been taken to the woodshed. As you can see, this was not so long ago, almost a $70 stock. So this company's not going out of business, and the $9, $9.50 share price, and I'm looking to the left, $654 million market cap, indicates that the street hasn't written them off yet. TOO. What I did here is try to highlight. This is really a cup and handle pattern. I don't have on the screen draw on these drawing tools. I don't have the. Actually, I do have a parabola, but I'm not going to do that now. You can see, just cut off the top of that circle, and what you see here is this part here is the cup, and there's your handle. Cup and handles are bullish patterns. So you're looking at, you can take it on a breakout of the handle if you wanted. I'm not crazy about that trend line because it only has a couple reactions. This is your go level right here. This is the all clear if and when this line's taken out. 672, it will have entered that gap, and yes, you have the top of the gap here, but I'll tell you that's very thin. Look at the volume at price histogram. This was just a whoosh, quick meltdown. So my expectation is, although you probably could have a reaction there at the gap, I wouldn't even be concerned on taking profits there. I'd ride out any pullbacks. If it backtests that line, if it takes out that 672, if it backtested, I would load up, add a little more, and with a stop not too far below, and expect a move up to possibly this downtrend line, and ultimately this level here, this horizontal level around 13. We'll call it 1350 for those of you that like round numbers. All right, we'll look at one or two more here. TNK, can't recall if I covered this one yesterday. Not crazy about the shape of the MACD on this divergence, but it is divergence nonetheless. You can see the bullish divergence here, this wedge type pattern. It's currently at the bottom of the wedge. More importantly, look at these horizontal lines here. Look at these reactions back here in late 2014, early to mid 2014. Let's see how much farther back that goes. This was obviously a long back here. Must have been on that breakout. And we had that double negative divergence on the high. So back here, a few years ago, we had a divergent low with this bullish falling wedge. And it broke out, and it went in a sideways range for a while. And this is what I talk about often, these ranges. The longer a stock trades in a sideways trading range, that's energy. It's fuel that's building up. And so once the stock finally breaks out, the more powerful the move. And look what happened once it took out that resistance level. Boom, huge move up, pulled back, tested almost pretty much the top of that level. Did so for a while. In other words, you extend that out, you can see, and then boom. That was a strong move in that stock from, $3 all the way up to, almost $9. And then that ended in a rising wedge type pattern. You can extend that line. So basically all this was a breakdown and a high level back test followed by a vicious bear market. And here we are, come full circle again. A little wedge type pattern, descending channel, call it what you want, but you have a pretty nice downtrend line. Again, I showed that on the daily chart with divergence in place. So at support to boot. I don't think you can go wrong. This is a type of stock at this point where I like to buy in this area. I like to buy it at the bottom of the wedge as well as that long-term support with a stop not below versus waiting for a breakout. You wait for a breakout from this point, again, because I can quantify my loss, my downside risk. However, to wait for a breakout from where it's at right now, I have to move that line to grab that point. Having a hard time doing it. That's roughly another 12% you leave behind on your. That's if it breaks out. Then you have to wait till it breaks out. That's about 15% or so just to kind of get in early on a breakout. So I'd rather position here at the bottom of that. If and when it breaks out and the sector is confirming, then I can always add, and it's probably going to take that stock up to at the very least this anywhere around these resistance levels. THT, let's run through these a little faster. This video is getting long. There's a nice support line there. Another horizontal support at 513. Here's your range right here. This guy's trading in this range, sideways trading range. So that's the big move will come once it breaks below or above this range, and everything that I'm seeing sort of indicates a lot of what I'm seeing indicates that that's going to go to the upside, and if it does, 1530 looks like my first target on that one. And ultimately, again, it depends on the sector. If the sector gains traction and enters a new bull market, I could easily see this one going back up to that 42-ish level. All right, a couple more and then we'll wrap it up. LPG, anything here of interest? Yeah, nice divergence. Look at this bullish divergence, big wedge type pattern. Bottom at that, right at the bottom of that pattern right now. There's some overhead targets. Not my favorite, but a nice one. TNP, another divergent low recently. There's a downtrend line to contend with. There's some targets around 680 is a target if and when this level goes. Then this downtrend line to contend with. Let's see if there's anything on the weekly chart. Yeah, you can see on the weekly chart. We had a divergent low at this point. So this one's actually been moving up since or late 2012. So not a bad one. And I think I've just got a couple more. CPLP, Capital Product Partners LP, looks like a breakout here. We don't see any volume. This was a breakout without any oomph. So you want to watch it. The breakout's still held, and not every breakout has to have that above average volume that I talk about, but the chart looks nice, divergent low, well-defined trend line, a breakout. So this one's either going to fall back if the sector can't get some traction here. It'll fall back probably within this pattern, and then you watch for the next breakout, or keep an eye on it. If it starts to move up, you'll probably begin to see volume come into it, and then you have a resistance level here, 380-ish. Next one up there is 475, and so on. You can see them on the chart. If you have any questions, just send me a message. I'll wrap up with this one. This was one that I did cover yesterday. It's a smaller one. We're down now to a $374 million market cap. GOGL, Golden Ocean Group. But you can see it punched out of this base yesterday, and now it's back testing that base right there. See that? So this is an objective entry right here with a stop not too far below. It may fall back in. This may prove to be a false breakout, but I mentioned before we only had these intraday breaks, these candlestick wicks. This one we actually had a close yesterday above there, and now we're back testing. So again, this sector needs a little more confirmation, but if you're a little aggressive and you're looking for some exposure somewhere else, you can start nibbling at these stocks. That's what I do. And if and as the case firms up, I'd be more apt to average up on my price or up on my cost basis now than average down. In other words, add only on strength. Yes, I'll be adding at less favorable prices, but you don't want to dig yourself in a hole in this sector, especially if it has another leg down. Okay, guys, this has been Randy Finney, right side of the chart. This one's gone long enough, so if you have any questions, as always, shoot me a private message, or preferably if it's something others might benefit from, just post it in the trading room. Thanks a lot.